Welcome to the Deep Dive. Today we're tackling a real head-scratcher in the finance world. We're looking at why a company's stock would actually drop right after announcing they've raised millions, even hundreds of millions of dollars. Seems backward, right?
It really does. It's this odd good news, bad news scenario. We've got two companies here, Bitcoin miner IREN and the treasury company, kindly ND, now Nakai, both managed to secure some serious capital injections, big money. And yet, the market's reaction, selling off their shares pretty sharply after the news broke.
And we're not talking small change. IREN pulled in, what, $875 million?
Yeah.
And Naka secured $250 million. In this market, getting that kind of cash should be a win.
Yeah.
But see, seems the way they got the money using something called convertible notes that really spooked shareholders.
Yeah, exactly. And that fear isn't just, random panic. We know that VC funding in the crypto space has really dried up. Sources are showing something like a 59% drop in available funding quarter over quarter. That's huge. So these companies desperately needed the cash. They got it. But the method, that's what the market punished.
Okay, so our mission today is to figure out what these convertible notes actually are, why they make investors so nervous, and how these companies tried to soften the blow. Okay, let's unpack this. Where do we start with these notes?
Well, for the company raising the money, they can seem quite attractive, offering flexibility. But yeah, for your average investor, they can feel pretty complex.
Right. Can we simplify it? Maybe an analogy.
Let's try this. Think of a convertible note, like a loan with a secret door. Okay.
A secret door. Okay, I'm listening.
So initially, it's just straightforward debt.
Yeah.
The company borrows money, owes it back with interest, standard stuff. But buried in the contract, there's this clause, the secret door. And under certain conditions, the lender can choose to open that door.
And what happens when they open it?
Their debt.
Right.
It transforms into equity, into shares of the company. So they switch from being someone the company owes money to being a part owner of the company.
Ah, okay. And that's the part that freaks out the existing shareholders.
Precisely. Because for that transformation to happen, the company has to suddenly issue a whole bunch of new shares. The core fear, the really fundamental one for investors, is dilution.
Dilution. Okay, let's use a metaphor for that. Imagine the company's total value, its market cap, is like a big pizza. If you own stock, you own a slice of that pizza, your percentage. So when the company converts, say, $875 million worth of these notes, they're essentially cutting a ton of new slices.
You got it. Exactly. Suddenly, your original slice, it represents a smaller piece of the whole pizza. Even if that new money, that $875 million, is eventually used to, I don't know, buy a bigger pizza oven and make the whole company more valuable later, in the immediate term, your slice just got smaller. Your ownership percentage shrinks, your voting power dilutes.
And that's why the stock price drops almost instantly. People see their slice shrinking.
Right, and that fear gets amplified when you remember the context. VC funding deals are down, maybe 15% fewer deals happening. Capital is tight. So any hint of dilution feels even riskier.
But isn't securing $875 million in this climate still a massive positive? Shouldn't that outweigh the dilution worry eventually?
That's the tension, isn't it? The market sees guaranteed dilution, maybe years away, but guaranteed nonetheless, and reacts now, even if that cash prevents the company from, going under tomorrow.
Okay, let's look specifically at IREN, the Bitcoin miner. They announced this huge $875 million convertible senior note offering. The stock actually had a decent day, up almost 7%. But then the announcement hits after hours and boom, down nearly 5%.
Yeah, swift reaction, clear message from the market. And IREN said the funds were for, general corporate purposes, working capital, pretty standard operational stuff. Should be reassuring, right? Keep the lights on, maybe expand a bit.
But the mechanism, the convertible note, just overshadowed that.
Completely. Investors saw convertible and headed for the exits.
But IREN must have seen this coming. They mentioned using some of the money for something called capped call transactions, a protective measure.
Yes. So that was their attempt to manage the fallout, to basically calm the market down.
So what is a capped call, in simple terms?
Think of it like prepaid insurance against excessive dilution. It's a separate financial instrument, an option, that IREN buys at the same time they issue the notes. If their stock price goes way, way up in the future, which sounds good, but could trigger a massive conversion of debt into tons of new shares, the capped call kicks in. It effectively puts a ceiling, a cap, on the price at which those notes convert.
So it limits the number of new shares created, reduces the dilution hit on the existing shareholders.
Exactly. It limits how bad the dilution can get, especially at very high stock prices. They're trying to protect the ordinary shares.
Wow. So they're basically spending some of the money they just raised to buy protection against the potential negative consequences of raising that money.
What's fascinating here, they're doing this proactively. They announced the notes and the capped calls together. They even offered an extra $125 million in notes just for the initial buyers, also convertible. It just underscores how much they knew they needed this defense mechanism. Without mentioning the capped call, that stock drop might have been even worse. They had to signal they were trying to manage the dilution risk up front.
Okay, so IREN went on the defensive. What about the other company, NACA, formerly Kindly MD? Their stock also dropped, but less severely, right? After their $250 million convertible note deal.
Right, a smaller dip. About 1% during the day, then almost 3% after hours. So still negative, but not quite the same reaction as IREN.
And their deal structure was a bit different, wasn't it, with a fintech company, Antalpha?
Yes. And the purpose of the funds was very specific. That's key here. NACA stated the money is primarily earmarked for expanding Bitcoin holdings within their Kindly MD Bitcoin treasury.
So not just general keep the lights on money. It's a strategic move directly related to their core business holding Bitcoin.
Exactly. It's an offensive move, in a way. Plus, they're also using part of it to clean up their books.
Right, replacing an existing $203 million loan that was secured by Bitcoin. So refinancing and growth funded by this note.
Correct. And the partner, Antalpha, specializes in digital asset finance. NACA seems to believe this specific structure, this partnership, might actually lead to less dilution risk compared to standard convertible debt.
How would that work? Less dilution.
Well, the details aren't fully public, but the implication is that the terms might be more favorable, or perhaps the conversion triggers are different, given the specific strategic alignment with Antalpha. It's presented as a more bespoke arrangement for a company whose main asset is Bitcoin. Antalpha even provided an interim Bitcoin-backed loan while the main deal closes, showing that close relationship.
Interesting. David Whaley from Nakamoto even framed it philosophically, didn't he? Something about Bitcoin companies backing Bitcoin companies.
Yeah, he did. He suggested this partnership shows the power within the ecosystem itself. And he said they're trying to lay the groundwork for future financing structures specifically designed for the unique needs of companies holding large Bitcoin treasuries.
So the argument there is almost, yes, it's a convertible note, but trust us, this one is different. It's strategic for the whole Bitcoin space.
Pretty much. It's an attempt to reframe the narrative away from pure dilution fear towards strategic ecosystem-level value creation.
Okay, so let's zoom out. We have IREN raising huge money, but immediately buying dilution insurance. We have NACO raising less, but framing it as a strategic Bitcoin play with a specialized partner. What does this tell us about the broader crypto financing landscape right now, especially with that 59% drop in VC funding looming large?
If we connect this to the bigger picture, it paints a picture of, frankly, strain. Companies need capital, but the easiest routes, like traditional equity or maybe bank loans, are harder to come by or less attractive. So they're pushed towards instruments like convertible notes, even knowing the market hates them. The success of getting the money is almost secondary to the negative reaction to the method.
It forces them to get really creative, doesn't it? Capped calls, specialized partnerships, strategic justifications.
Absolutely. These aren't just standard fundraising deals anymore. They're complex maneuvers designed to navigate a very tough environment where investors are hypersensitive to dilution. It suggests convertible notes might be becoming maybe not the last resort, but certainly a less preferred option they're forced into.
So what does this all mean? It means raising money is incredibly complicated right now. It's not enough to just get the cash. Companies have to actively battle the perception of dilution, spending extra money on things like capped calls or crafting these very specific narratives like NACA's Bitcoin treasury focus just to make the deal palatable.
It's a high-stakes game, and the cost of capital when you factor in these extra measures and the stock price hits is effectively going up, which leads to a really interesting question for you, the listener, to think about. Given how much the market clearly dislikes dilution, are we going to see more of these highly customized, innovative structures? Will deals explicitly designed to benefit, say, the Bitcoin ecosystem at large become the only way for specialized companies in this sector to raise capital without getting hammered? Is that the new standard?
That's definitely something to chew on. Will necessity force even more creativity in how crypto companies fund themselves? A great question. Well, that's our deep dive for today. We hope unpacking these convertible notes and market reactions was helpful. If you found this useful, please do follow, like, and share this deep dive with others who might be interested. And of course, for more insights into Bitcoin and the surrounding ecosystem, make sure you also follow What Bitcoin Taught Me. You can find us on Twitter X, Nostr, Blue Sky, Threads, Instagram, Facebook, and LinkedIn. Thanks for joining us, and we'll catch you on the next one.